Hello, welcome to FreeFX. Today is Saturday, the 8th of October. We've got a lot to talk about, so let's get started. So, I had an amazing sense that this was going to be a great week with the non-farm payrolls to crown it and finish the run we've had on the S&P 500. Now, you might remember in my last video, I was highlighting this divergence on the commodity channel index. And as you can see, it's sort of played out the same way as it seemed to suggest. There's no certainty in these things. But we had essentially the run from the 3rd of October, and then the divergence started on the 4th. Really, it wasn't a divergence to begin with. It was this point here on the 5th, which is Wednesday, where we had a rise in the S&P back to the Tuesday high. And then the CCI was dipping. Eventually, they came down together. The important point, the inflection point, was around the basis. That's the orange moving average there for the Bollinger Bands. And price sort of became stuck around these levels. We're talking about 3,740. And really, there was no resolution until Friday. So, a great week because if you remember, I talked about this level, which is the 16th of June low. And if you extend that, in fact, we should probably start extending that now. We got ourselves this break. We had a break since the end of September. We tried to break through right at the end, so the 30th of September. So a week ago, we had the break, and then it seemingly didn't. It was a false break, so a fake out, as we call it. This latest version of that is also a tentative break because we've not really conquered, in a way, a level that commands confidence that we've broken through those lows and we've closed below the level, but we haven't really confirmed it in, say, another week's trading, etc. As you can see previously, we had more than one day. So if you take 4 hours times 4, that's 16 hours. It's like a trading day essentially. But we didn't finish certainly a full week below that level. So we certainly have a lot more to look at. And if I extended that to the daily, we certainly have room for more of this because we are at these levels now, and it does seem like we have to gain some confidence and traction. The interesting thing about this week was that the non-farm payrolls came out like this. So we had the numbers, the headline figures, and of course the beat was the one that caused some of the price action that we saw. So the better than expected result was for the private payrolls coming up. They came up at 288,000, and that's obviously more than the expected 265. And the previous. So it beat the previous and the consensus figure. The other important thing, of course, was the unemployment figure. And that was really what sparked the flames, I think, because it dipped from 3.7% to 3.5%. If you remember, when Janet Yellen was the chairwoman of the Federal Reserve Bank, the target for inflation was to raise inflation up to or close to 2%, and the employment to keep unemployment down to 5%. So now we got unemployment to 3.5. So unemployment is in a very good place by those standards of the QE era, QE2, QE3 era. And employment is strong, on a month-by-month basis anyway. So we have to kind of think of that as what is the perception for markets in terms of what happens next. Clearly, the Fed speakers have been saying quite consistently they do not see this as a threat, as in, sort of devaluation of financial markets, and they don't want to stop their fight for inflation. which means that a strong employment report with lower unemployment is in a way creating this narrative that there's even less of a reason for the Federal Reserve to slow down. As you can see, the target rate currently is 300 to 325, and we have a probability of a 75%, 75 points, or 0.75% rate increase on the 2nd of November, and it's gone up to 81%. Just earlier this week, it was 67%. I know that off the top of my head. This is 81%. So clearly, the 50 basis points has gone right down to 18%. The 75 basis points is now the strongest contender. So we know that, we've seen a dot plot. We're well beyond the 4% target rate for the year. And, with this rate hike, we'll get to 375 points. So we're getting closer to that 4%, which means that the December could be a 50, which is this at the moment. So 375 to 425, if you take what just came before, and 50 points is where we get to with this. So the strongest possibility at the moment is that for December, they will do less. They will do 50. And then we go into next year, 2023. And for that, the picture is a little bit more mixed. So 375, 425, from 425 to 450, the strongest possibility there is for 25. Okay, 25 basis points rate hike. So the whole system is pricing in a slowing down of rate hikes next year. However, as you can see, within a few days, probabilities for these scenarios change fairly quickly, sometimes dramatically. So I wouldn't rely too much on them in sort of making informed decisions when you are trading, as I am personally, trading short term. It's not really something that can help really shape your trades, but it's good to have an awareness of where. So the interesting thing about this is that technical analysis gets a bad name, but then if we look at this, you can say quite clearly, okay, so I have a moving average here. Now, a lot of these moving averages, you hear people in the industry or retail traders like myself who have some traction will favor one moving average or a combination of moving averages over another. And really, I find that's not really like a magic formula that one works over more than the others. Clearly some people are absolutely passionate about certain combinations that work for them. You hear some people doing like the 3-period moving average versus the combination with another longer one, like the 20 or something. Some people will sort of scrabble over the difference between a 20 and a 21. 50, some people come up with some wacky numbers like 17, and the standard ones would be the 200, that's the sort of long term. Then the 100 would be half of that, which makes sense. The 50. When you get to lower numbers, it's much and such. It's not really, you have to do some statistical studies to prove that in a certain asset class, doing a particular trading strategy with one or the other, you'd have to do back testing basically. So without that information, it's up for debate really. So I think the 21 in this case, it's just something I came up with that seems to respond well to price in the way that it interacts with this particular instrument, the S&P 500 in the SPX form. And I was looking at this just before the end of the week, and I got into a trade, and I started thinking that it was very much a repeat of this. So if I just do this for you so you can see clearly what I'm looking at, essentially we have two areas of interest. Now, this is not what I was looking at, it was this one. So if I just kind of highlight the whole thing, this was, if you remember, just the center of this circled area. That red candle was what I call CPI Tuesday, because it was a big drop that occurred on the 13th of September. That was a Tuesday where the CPI data came out a bit hotter than usual, or than expected, not than usual. So the inflation figures basically confirmed that the inflation problem had gone away. And previous to that, speaking of technical analysis, we came up to the 21 moving average, and then the basis, which is the orange moving average, which forms the midpoint, if you like, for the standard deviations that we use in the Bollinger Bands. Now, as you can see, this happened. It could have continued higher. The general downtrend is to the downside. So expectation was that, this continued. We got to the zero level on the commodity channel index on the daily, which as I explained before, it's a strong, when you're in a downtrend, you come up to the zero, it's a strong resistance point if you're using that as a signal indicator, if you like, or confirmation indicator. And so we got past the 21 and then up to the 20 period moving average, and then we came down and then broke to new lows compared to this point here, and continued through the end of September up down to the June lows. So this was what we had back then, and we didn't test the 21 moving average until this week. So I'm going to move this circle to this, and you can see that it was almost a repeat of the same. Now we've had 1, 2 up candles as opposed to 4, so the rate of change was greater. In just the first 2 days of the trading week, we achieved that bounce from the lower band straight back above the June lows level and up to this area between the 21 and the 20 moving averages. But we were kind of set up so that midweek, Wednesday, Thursday, we were sort of looking a little bit uncertain that we could continue higher. In fact, midweek sort of stalled completely. There wasn't really much fuel for any traction, and then we had this drop. Again, on the CCI, you can see on the daily, we didn't quite get to the zero, but we got to as close to that. It was minus 30. So it was starting to do that. We saw the divergence on the 4-hour, and I really thought this was the perfect time to trade that. So what did I do? Well, on the Wednesday, I sold here, and basically I bought into this, and then I essentially, all these trades, as I mentioned before, I won't be talking about them because I already talked about them. So it was a bit choppy around here, so it wasn't the best end of September last 2 days, but I eventually found going long, great start of the week. Tried to get short early, didn't quite work completely, but went short again on a Wednesday, and then sold it back on the Friday. When it says buy, it's basically closing that position, short position. On the Friday itself, I had another 2 shorts here and here. Okay, you can see it was just around these levels, and closed both of them. So altogether on the Friday, I closed the Wednesday trade and the other 2 trades short, and made about 48 points. So not a bad week, not a bad week. Going into next week, obviously we've got the precedent here, taking the spotlight back onto here. You can see that what happened then was we continued lower. We are at the June lows already, so it's kind of hard to know whether we break straight through to new lows or not. To put it into perspective, it's always worth going to this. Now I think I'm going to have to take off the trades because it's getting a little bit busy. So I'm going to take off the executions, which sounds quite... Okay, let's see, executions. Now, if we go right back to the pandemic move there. So the pandemic move came to about 3,370, let's say, and currently we are here. Okay, so we're about 300 points, but visually you can see that it's not, it's not that much to get to there. The question is what happens when we get there. So I suppose one would like to perhaps think of this. Okay, so that's your pandemic level, and then we had the crash. So if we got to that level, when will we get there? If we got there this month, within the next couple of weeks, unlikely, but I mean, let's say that we did by the end of October. Would that be a deleveraging point? Would that be a point of no return and a complete washout? Historically, we've not really stopped except for this pandemic sort of rinse out. We haven't really stopped, so it's been an uptrend for a while. There was a 2018 pullback, this drop here, but we recovered fairly quickly. That was from December 18, that low, and by May 19 we were sort of back to making new highs. So we just have to kind of see what we've got in store next week. So next week we have, for the US markets, let's say for the US trading markets, we have PPI on the 12th. So that's the Wednesday. And then we've got core inflation, jobless claims, etc., CPI. So all very important things, of course. We had the CPI Tuesday on the 13th of September. And then on the 13th of October, we've got more CPI data. Okay, so that's basically going to be the Wednesday this time. Oh, sorry, Thursday. So Thursday this week, very important day for all sorts of things. And, it's looking like the core inflation is going to be a bit higher. And that means it's probably going to feed into the narrative that the Fed doesn't particularly want to slow down its pace of rate hikes or QT and all the measures that they are implementing. So great stuff for reflecting on this week's price action on the S&P 500 and reflecting on what may happen next week. And with that thought, I will leave you to your weekend, and I'll see you next week. Take care. Bye-bye.